Here's a fun fact. The average investor underperforms the market by almost 3% every single year. Not because they're dumb, but because they try to time it. They panic when things crash, they get greedy when things spike, and basically turn everyone's portfolios into a roller coaster. But the top traders, they don't wait for the perfect moment. They know something that most people don't. Consistency beats perfection in the market every single time. Today I'm going to be breaking down why the most successful investors are boringly consistent, even when the markets are going haywire. We'll look at why small, steady investments work, how they remove a lot of emotion, and the data that proves it beats trying to be a psychic stock picker. So when the market is tanking, your adrenaline says sell everything. When the market is pumping, it says buy everything, because it feels like a great time, right? Everyone's super adrenaline rushed. This is why studies from Dalbar show that the average investor earns way less than the S&P 500 because emotions make us trade at the worst possible times. Consistent investing, like putting the same amount every single month, forces us to keep emotions out of the equation entirely. You're not buying because you're scared or hyped up. You're buying because it's Thursday and I get paid today. When I first started investing, I used a micro investing app. So if you don't know what that is, basically I spent money on my debit card and every single time it would just round up to the nearest dollar, take those pennies and invest it. So if I bought something for $9.50, it would take 50 cents and invest those 50 cents from you. I did that for a couple of years, ignoring it really. And it seemed to have worked, but then I'd actually checked, I was losing money. And I don't know how. They were investing for me. I thought they were professional. Either way, I took that money out and started investing myself. And then I lost even more of it. A few thousand to be exact. Mainly because my mindset was like buy low, sell high. I was trying to game the market. I was trying to time it. I was looking at graphs and saying, oh, it went down back here, so maybe it'll go down again here. I was totally wrong. I screwed that up immensely. And again, I did that because that's what I thought I was supposed to be doing. And then at one point, I started just moving into consistency. I automated my paycheck to automatically go into my investment account and invest in a few boring ETFs. And I've been doing that since, back in the green, and it feels amazing doing nothing and barely thinking about it. Let's be real, cash sitting in your account is like pizza sitting in front of you. It's not gonna last very long. Right? At the end of the day, you'll find a way to spend it. So there's data from Vanguard that shows that people who set up automatic monthly contributions invest 27% more per year than people who wait until they have the exact extra cash. Translation, automation stops you from sabotaging yourself, basically. By setting up these auto investments, you're turning your money into a worker bee that literally takes no time off. You don't have to think about it, and you're way more likely to hit your long-term goals. I cannot tell you how much stress this relieves by following this method. Here's the big myth. You can't time the market. Here's the truth. Even the pros can't time the market. Consistency. Are you a pro? Are you? A recent SPIVA report found that 80% of active fund managers underperform the market over 10 years. Can you believe that? People are paying professionals to lose their money. They do it for a living. But if you're always investing, whether the market's up, down, or sideways, your timing is always technically right. Why? Because you're catching the dips and the climbs. That's called dollar cost averaging. If you don't know what that means, neither do I. So I had to Google it. Basically, it means you're building wealth while everyone else is stressing out, trying to be like Nostradamus. And here's the kicker. If you missed just 10 of the best investing days in the market over 20 years, your returns would be cut in half. And those days often happen right after the worst days. So if you're on the sidelines, you're missing out. You're missing the rebound. When I was paying off my 100K of debt, I still invested small amounts every single month, even if it was 25 bucks. Why? Because I didn't want to lose the habit. Habits are the secret sauce here. If you only invest when you feel like it or when TikTok tells you to, you'll do it way less than you should. Listen, I'm a regular dude who consistently dumps money in every time I get paid. And I'm up 14% over the last year. When was the last time anything got you 14% back? And again, regular dude, I don't read investing articles. I don't subscribe to like company earning calls. Like, forget all that crap. You don't need to know it. I am most likely going to succeed by being boring. So here's the bottom line. Consistency removes emotions. Consistency keeps you on track, and consistency beats market timing even when the world feels like it's falling apart. Set it and forget it and let the market work for you, because the best investors aren't the smartest in the room. They are the most consistent. Did I just call myself dumb? If you found this video helpful, please like and subscribe. It could help me buy a boat. It would also mean the world to me as a small fry creator. And I'll see you next week.